You deposit $1,000 into your bank account. You open your banking app. It says $1,000. Clean, simple, sitting right there. Here's the uncomfortable part. Most of that money isn't actually sitting there. Right now, today, a big chunk of it is probably funding someone else's mortgage, or sitting in a small business loan, or backing a car loan for a total stranger 3 states away. Your bank didn't put your cash in a vault with your name on it. It lent most of it out almost immediately.
And your app still says $1,000. So here's the real question, the one that should genuinely bother you a little. If every single person who has money at that bank showed up today and asked for it all back at once, could the bank actually pay everyone? The honest answer is no, not even close. And banks have known this openly for hundreds of years. It's not a secret, it's not a scandal, it's not a loophole someone's getting away with. It's literally how the entire banking system is designed to work. By the end of this video, you'll understand exactly why that's true, why it works fine almost all the time, and what actually happens in the rare moments it doesn't, including 2 moments, decades apart, where it happened in front of everyone in completely different ways. This system has a name: fractional reserve banking. And once you know the name, the concept underneath it is actually pretty simple. Banks are required to keep only a fraction of the money you deposit on hand at any given time. Not all of it, a fraction. Historically, in a lot of banking systems, that number has hovered somewhere around 10%, though the exact figure varies by country and has shifted a lot over time. And in some major economies, it's dropped to functionally 0 in recent years. The rest, the other 90%, or close to it, the bank is not just allowed to lend out, it's expected to. That's the actual business model. This isn't some hidden fine print. It's the foundational rule the entire modern banking system runs on. And it's been that way since long before anyone reading this was born. A bank makes money by taking deposits, paying a small amount of interest, or none at all, and lending most of that money back out at a higher interest rate to someone else. The gap between what they pay you and what they charge borrowers is essentially the bank's entire business. So when you deposit that $1,000, the bank keeps maybe $100 on hand, and the other $900 goes out the door, usually within days, into someone else's loan. Here's where this gets genuinely wild, because it's not just about where your specific money goes, it's about what happens to the entire economy because of this process. Say the bank lends your $900 to someone buying a used car. That person doesn't take the money home in cash. It goes into their bank account, maybe at the same bank, maybe a different one. Now that account shows $900. That bank, following the exact same rule, keeps a fraction of it and lends the rest out again to someone else for something else entirely. That third person deposits their loan into their account, and the cycle keeps going. Notice what just happened. Your original $1,000 is still showing up in your account. The car buyer's $900 is showing up in theirs. The next borrower's amount is showing up in theirs too. Nobody's numbers went down. But new money didn't get printed by a government mint anywhere in this story. It got created, genuinely created out of essentially nothing but a signature on a loan agreement, purely through this repeating cycle of deposit, lend, deposit again. This is, quite literally, where most of the money in a modern economy actually comes from. Not from a printing press, from this loop, repeating across millions of accounts simultaneously, every single day. Economists call the total effect of this the money multiplier, and it means the actual amount of money circulating in an economy can end up being several times larger than the amount of physical cash and central bank reserves that originally exist. Your one deposit through this chain might indirectly become the foundation for several $1,000s of total money moving through the system. That's not a bug. That's the entire point of how modern banking creates the credit that funds houses, businesses, cars, and virtually everything else that gets financed rather than paid for outright.
So, if no single bank actually has enough cash to pay back all its depositors at once, why doesn't this fall apart constantly? The honest answer is statistics, plus trust, working together. On any ordinary day, only a small percentage of a bank's depositors actually want their money out in cash at the same time. Most people leave their balance sitting there, spend a portion of it through cards and transfers, and never physically ask for a stack of bills. Banks study this pattern closely. How much cash typically gets withdrawn on a normal Tuesday, how much extra tends to get needed around holidays, and they keep enough on hand to comfortably cover that normal, everyday flow.
This works because of something close to a law of large numbers. Individually, any single depositor's behavior is unpredictable. But across thousands or millions of depositors, the pattern becomes remarkably stable and predictable. It's the same principle an insurance company relies on. Nobody knows which individual house will catch fire this year, but insurers can predict with real accuracy roughly how many houses out of a huge pool will have a claim.
But notice the word doing all the work in that explanation: trust. The entire system depends on depositors believing their money is safe and available whenever they want it, so that they don't all try to withdraw it at the same time. As long as that belief holds, the math works perfectly, day after day for decades. The moment that belief breaks, even briefly, even for reasons that turn out to be wrong, the entire foundation the system rests on starts to shake. Real quick, if this is the kind of thing you like having explained clearly, that's basically the whole channel. Subscribing to Compound Economy means you catch the next one, and it genuinely helps us keep making these. Okay, because what happens next is the part where trust actually breaks, and it's a genuinely fascinating, slightly terrifying mechanic. A bank run happens when a large number of depositors, all at roughly the same time, decide they want their cash out right now, usually because they've heard or fear that the bank might not be able to pay them later. Here's the part that makes this genuinely strange. The fear itself is what causes the problem, almost independent of whether the original concern was even true. If enough people believe a bank might fail, and they all rush to withdraw at once, the bank runs out of the cash it keeps on hand within hours. Not because it was secretly insolvent to begin with, but simply because no bank, anywhere, keeps enough cash on hand to pay everyone simultaneously. That's true of every bank on Earth, even a perfectly healthy one. The fear becomes self-fulfilling. A bank that would have been completely fine gets pushed into failure purely because enough people got scared at the same time. To really understand how strange this dynamic is, it helps to watch it happen slowly, in the physical world, the way it happened for most of banking history. In September of 2007, a mid-sized British bank called Northern Rock became the first UK bank in well over a century to experience a full, public, old-fashioned bank run, the kind with actual physical lines of people standing outside branches, waiting for their turn to pull cash out. The bank had grown quickly in the years before by relying heavily on borrowing money from other financial institutions to fund its lending, rather than mostly from ordinary customer deposits. When credit markets tightened suddenly and that borrowing became difficult, the bank needed emergency funding from the country's central bank just to keep operating normally. That request became public, and the moment it became public, something almost mechanical took over. News coverage of the bank needing emergency support was enough, on its own, to convince a large number of ordinary depositors that their savings might not be safe. Lines began forming outside branches the very next morning. People who'd banked there for years, with no actual reason to doubt the safety of their specific deposits, stood for hours, specifically because they saw other people standing in line and assumed the worst. Some branches had queues stretching around the block, growing throughout the day as news of the queue itself spread and pulled in even more anxious depositors. Over the following days, depositors withdrew several billion pounds in what remains one of the most visually documented bank runs in modern history. Genuinely filmed on the news, replayed constantly, becoming the defining image of the whole event. And here's the detail worth sitting with. This was, at the time, a viable institution whose core lending business wasn't fundamentally broken. What actually took it down, in large part, was the public panic itself, responding to a funding problem that a calm, gradual response might have handled without ever reaching this point. Eventually, the government stepped in, guaranteed deposits explicitly and publicly to stop the queues, and the bank was later taken into temporary public ownership before being restructured. The entire event, from the first news report to queues stretching around city blocks, took a little over 24 hours to really take hold and several days to fully play out. In 2007, that counted as a fast-moving crisis. Notice that number, because it's about to look almost quaint by comparison.
In March of 2023, a fast-growing regional bank in the US saw this exact mechanic play out again. Same underlying fear, same self-fulfilling logic, but at a speed nobody had really seen before because of one modern ingredient that didn't exist in 2007: instant mobile banking combined with real-time social media.
This bank had a large concentration of depositors from one specific industry, largely tech startups and venture capital firms, many holding balances well above the standard insured limit. When concerns began spreading about the bank's financial position, some grounded in real balance sheet issues, some amplified purely by panic feeding on itself, depositors didn't need to physically show up anywhere. There was no line to stand in, no branch to drive to. People pulled tens of billions of dollars out through banking apps from their phones, largely coordinated and amplified in real time across social media and group chats within the startup and venture capital community. The entire collapse unfolded in about 48 hours. Compare that to the multi-day, physically visible unraveling of Northern Rock. The mechanics were identical. Fear spreads, people rush to withdraw. No bank keeps enough cash on hand to survive that volume of simultaneous withdrawal. But the modern version compressed a process that used to take the better part of a week into less than 2 days, because withdrawing money no longer required showing up anywhere in person, or even necessarily waiting for a branch to open. Regulators had to step in quickly with emergency measures, specifically to guarantee deposits above the normal insured limit and stop the panic from spreading to other regional banks that people worried might be similarly exposed. And just like in 2007, the core lesson wasn't that the underlying system is broken. It was a strikingly clean, modern demonstration of the exact same fractional reserve mechanic we've been walking through this whole video, just moving at the speed of a push notification instead of the speed of a physical queue. Put the two side by side, and the pattern becomes obvious. Same trigger, a funding concern becoming public. Same mechanic, fear becoming self-fulfilling because no bank can pay everyone at once. Same outcome, a fast collapse followed by emergency government intervention to stop contagion. The only real variable that changed between 2007 and 2023 was the speed of communication. And that variable alone took an already fast crisis and made it roughly 10 times faster. Stepping back from both case studies, it's worth understanding the actual tools that exist specifically to prevent this cycle from spinning out as often or as badly as it did before they existed. After a wave of bank failures during the Great Depression, decades before either case study we just covered, governments built two major tools designed specifically to break this cycle of fear. The first is deposit insurance. In the US, the FDIC, guaranteeing deposits up to a set limit, currently $250,000 per depositor per bank, even if the bank fails completely. Similar systems exist in most developed economies. The entire point of this insurance isn't really about the payout itself. It's about removing the reason to panic in the first place. If you know your money's protected no matter what happens, you have no reason to rush to the front of a line. which means the self-fulfilling panic loop mostly stops before it can even start.
The second tool is the central bank acting as lender of last resort. If a fundamentally healthy bank is genuinely just short on cash temporarily, the central bank can lend it emergency funds to cover withdrawals, buying time for panic to settle without the bank actually collapsing. This is exactly the mechanism Northern Rock initially requested in 2007, and a similar emergency backstop is what stopped the 2023 case study from spreading further into the wider banking system within days.
Together, these tools have dramatically reduced how often this kind of failure happens and how badly it spreads when it does. But neither case study we just walked through fully avoided the underlying problem. They show that even with these safety nets fully in place, the core fractional reserve mechanic can still get tested and still occasionally breaks through when panic moves fast enough.
None of this means you should be worried every time you check your bank balance. For the vast, overwhelming majority of people at the vast majority of banks, this system works exactly as designed, every single day, without incident. Northern Rock and the 2023 case study are genuinely rare, memorable precisely because they're exceptions rather than the norm.
But a few practical things are worth actually knowing now that you understand the mechanism. If you keep a balance meaningfully above your country's deposit insurance limit at a single bank, spreading it across more than one institution genuinely does reduce your exposure to the rare scenario where a payout gets delayed or capped. It's also worth knowing that the deposit insurance limit is a real, specific number, not a vague promise. Knowing what that number actually is for your bank and your country is a 5-minute check most people have simply never bothered to do.
And maybe the more interesting takeaway is just this. The next time your banking app shows you a clean, simple number, you'll know what's actually happening underneath it. Most of that money is out in the world right now, funding someone else's mortgage or business or car, quietly doing the actual work of creating the credit an entire economy runs on, and coming back to you reliably, specifically because almost nobody ever asks for all of it back at the same time. And on the rare occasions enough people do ask at once, you now know exactly what that looks like, whether it takes a week or takes 2 days. If you found this useful, subscribe to Compound Economy.